Hello everyone and welcome to part 2 of the presentation and lecture on tax administration and procedure. We will resume with the collection of taxes. So for the remedies in general, any reasonable method may be adopted by the government pursuant to the lifeblood theory, which states that the continued existence and effectiveness of the government depends on the regular receipt of public revenue. The legislature may adopt any reasonable method for the effective enforcement and collection of taxes, the most summary measures without divesting the taxpayers of their property without due process. The power to collect is implied from the power to impose taxes. There is an implied authority to devise ways and means to accomplish the collection in the most effective manner. Even in the case of tax exemptions, or when a taxpayer is invoking his or her right to be exempt from payment of taxes, collection of taxes should not be impeded or enjoined except upon a clear showing of such right. And finally, collections should be made in accordance with law. The BIR is, of course, the collection arm of the government, and it must do no less, particularly to strive to render service with utmost diligence and efficiency, because generally taxpayers perceive the tax office negatively with alleged corruption or other bad practices that people think the BIR does. So again, generally, judicial proceedings are not required in order to collect taxes, and no government could exist if all litigants are permitted to delay the collection of taxes by mere lodging of a case against the BIR. There are several remedies available to the government in order to enforce and implement the collection of taxes, the first of which is what you call the distraint of personal property. When you talk about distraint, this is the seizure of the government of personal property, be it tangible or intangible, to enforce payment of taxes to be followed by a public sale if taxes are not voluntarily paid by the taxpayer. There are usually two kinds of distraint: actual distraint, or there's a physical taking of the property, or constructive distraint, where the owner is prohibited from disposing the property. The following are the requisites for distraint. Number one, the taxpayer must be delinquent in payment of tax. Number two, there is substantial demand for its payment already. Number three, despite such demand, the taxpayer fails to pay the delinquent tax at the time required. And number four, the period within which to assess or collect the tax has not yet prescribed. The following are some of the properties that can be subject to distraint. Number one, all goods, chattels, effects, or other personal properties belonging to a taxpayer may be seized, but properties exempt from attachment, garnishment, or execution, and bank accounts. No need for inquiry into the bank accounts. However, there are certain properties that are not subject or should not be subjected to the distraint. Number one, bonds or cash deposits for possession of firearms. Otherwise, the objective of the law, putting up a bond in case of possession of firearms, would be frustrated or defeated. Number two, properties under custody of the courts, or what you call in custodia legis. So properties under judicial settlement without consent of competent court. So take note of the keywords without consent of competent court. Meaning, if you apply or ask for the permission of the court to take out that property in custodia legis in order to settle the taxes due from that taxpayer, then it is possible. And number three, properties which are exempt from either attachment or levy by special law, such as benefits from the GSIS. So how is this trained done? It depends whether if it is a tangible or an intangible property. For tangible properties, an officer will serve what you call a warrant of distraint, signed by himself, to the taxpayer, accounting for the property distraint, and that warrant is left with the owner or person in possession of the property taken. A statement of the sum demanded and the note of the time and place of such sale of this or the sale for that property must also be indicated. For intangible properties, it depends on the kind of property. For shares of stock, the officer will serve a warrant to the duly authorized personnel. Upon receipt of the warrant, the taxpayer shall not permit any transaction which may prejudice the collection of tax. For debts, the officer will leave a copy of the warrant with the person owing such debt or to the debtor of the taxpayer, to the effect that the person in control of any credits belonging to the taxpayer must pay the commissioner of such debt or credit. And lastly, in the case of bank accounts, they will be garnished by serving a warrant of garnishment instead of distraint. So it's a different term when it comes to bank accounts upon the taxpayer and the bank. So both are served with the warrants, with the bank later on turning over to the commissioner such amount sufficient to satisfy the claim of the government. So now, when is constructive distraint done by the government? In order to safeguard the government's interests, the commissioner may place personal property under constructive distraint if, in his opinion, the taxpayer is number one, retiring from any business, number two, is intending to leave the country or remove his property, or hide or conceal his property, or number three, is performing any act tending to obstruct proceedings for collecting the tax due. How is this done? The person in possession of property signs a receipt during the property distraint, and number two, he or she obligates himself or herself to preserve the same and keep it intact or unaltered, and not to dispose the same in any way without the express authority of the commissioner. So he provided with a comparison of actual and constructive distraint. Take note that both cannot be availed if the amount involved is not more than 100 pesos, although it doesn't happen anymore these days. The primary distinction between the two is that in actual distraint, there is an actual taking of possession or transfer of control of the property. Whereas, when it comes to constructive distraint, there is only a prohibition from disposition of the property. The purpose of an actual distraint is for an immediate step for collection of delinquent taxes, whereas constructive distraint is only for a preventive measure against the taxpayer from disposing that property, pending the final determination of his tax liability. Next, we have levy of real property. As a remedy of the government to collect taxes, the levy is a summary administrative remedy which refers to the act of seizure of real property belonging to the delinquent taxpayer. Such levied properties may also be sold at a public sale if, after seizure, taxes are not voluntarily paid. Take note that this is different from the other concept of levy that we previously defined. Levy as a legislative act, which is to determine the tax of a certain amount or of a certain percentage by enactment of a tax law. So there is a distinction between levying as a legislative act from levying as an administrative remedy. So how is it done? Real property may be levied before, simultaneously, or after distraint of personal property. The remedies may be repeated if necessary, and that revenue officers are not required to exhaust personal properties before proceeding upon real properties of a taxpayer. So it means if it is more efficient for the government or for the officers to run after your real properties first, then they can do that through the levying of real properties instead of distraint of personal properties. The requisites for distraint are similar for levy of real property. Take note that for levy to be effected, it is done by service of a written notice containing the following. Number one, the description of property to be levied. Number two, the name of the taxpayer. And number three, the amount of the tax and penalty due. Let's talk about redemption rights. Delinquent taxpayers or anyone for his or on his behalf shall have the right to redeem property sold or forfeited. If redemption is made by one who is not the owner, such owner can subsequently recover property from him. The person redeeming the property need not be a party in interest or related to the taxpayer as long as it is done for and on his behalf. Take note that the right of redemption within 1 year from date of sale reckoned from the date of registration of sale or declaration of forfeiture, as the case may be. And this 1 year may be extended by the courts. Finally, in case of property forfeited by the government, the forfeiture becomes absolute. Next, we have the remedy of forfeiture. Remedy involves the divestiture of property without compensation as a consequence of a default or offense. Directed against the property itself, and its is to transfer of the transfer of title from the forfeiture of personal properties enforced by seizure and sale or destruction of such. On the other hand, forfeiture of real properties enforced by a judgment of condemnation and sale in a legal action or proceeding, whether civil or criminal, as the case may require. Lastly, forfeiture or forfeited property rather may be destroyed by order of the commissioner when the sale or consumption of use of such goods are injurious to public health or prejudicial to enforcement of law. Next is a tax lien. So what is a tax lien? Basically, a tax lien is a security in case of default of payment of taxes. It's a legal claim or charge on real or personal property of the taxpayer. It doesn't arise by implication from the power to tax. A tax is not a lien on a taxpayer's property. Tax liens created by statute or by law are strictly construed and must not be given retroactive effect unless required by its terms. There is no tax lien or security where there is no tax obligation. Next, the tax together with interest, penalties, and costs is a lien on all property and rights belonging to the taxpayer, regardless of ownership and transfer. Finally, a lien is a charge on property and it gives right to resort to the property for the payment of tax. Therefore, a lien secures only the payment of tax and nothing else. Next, we have compromise and abatement as remedies of the government. Abatement has already been introduced to you at the end of part 1 of this lecture. So what is compromise? Compromise is basically a contract between parties by reciprocal concessions in order to avoid litigation or to put an end to one already commenced. This is pursuant to Article 2028 of the Civil Code. It is expected that neither party will be able to maintain the initial demands wholly unaltered, and changes are naturally made in the course of bargaining, and the final agreement rarely coincides with the original terms proposed. So compromise necessarily implies mutual agreement between parties. So insofar as taxation is concerned, your usual suspects are the BIR and the taxpayer. One party cannot exact from or impose upon another a compromise. So it has to be agreed by both parties involved. An offer of compromise does not therefore assume categorically a compromise until it is voluntarily accepted by the other party. So if the BIR suggests that a compromise be made, it's not perfected until accepted by the taxpayer and vice versa. So the following are your requisites in order for there to be a compromise. Number 1, obviously there has to be a tax liability. Number 2, there must be an offer of an amount to be paid by the taxpayer. And number 3, there must be an acceptance of the offer and settlement of the original claim. Take note that taxes are generally fixed by law and are not subject to contract or agreement between the taxpayer and the BIR. A compromise agreement or a legal compromise does not operate to discharge the tax liability where the law fixes a full amount of tax due unless there is an actual compromise of the tax in settlement of the taxpayer's liability. So who may compromise tax cases? From the government side, as a general rule, only the commissioner has the power to compromise both civil as well as criminal cases arising from violation of the tax code. This power is purely discretionary on the part of the commissioner, and the courts have no power to compel or require or even mandate the commissioner to exercise the discretion to do or to enter into a compromise agreement. The commissioner must consider not only the pecuniary benefit or interest of the government, but also justice, equity, and public policy. Your subordinate officers, however, like the regional director or the revenue district officer, may actually enter into what you call preliminary compromise, which is subject to review or approval of the commissioner. But once rejected, such rejection is final and binding unless again revoked by the commissioner. Lastly, the delegation of the power to compromise is actually prohibited by law. However, tax assessments issued by regional offices for basic deficiency taxes of 500,000 or less, as well as minor criminal violations, may be compromised by the regional evaluation board. So at the regional level, if it is only comprised of deficiency taxes worth 500,000 or minor criminal violations, then it can be compromised at that level. So extent of compromise depends on the kind of case involved. In civil cases, which particularly means liability for unpaid taxes, you can enter into a compromise if there is reasonable doubt on the validity of the assessment against the taxpayer, or when the financial position of the taxpayer demonstrates clear inability to pay or financial inability to pay. In criminal cases, these may be compromised except, number one, those already filed in court, and number two, those involving commission of fraud by the taxpayer. Now, there are minimum thresholds that you have to take note when it comes to compromise. The minimum compromise rate would be 10% of the basic assessed tax in cases of financial incapacity, and 40% of basic assessed tax for other cases like doubtful validity of assessment. So for example, if the BIR is assessing you for 100 and that you filed or requested for a compromise on the basis of doubtful validity of assessment, your compromise penalty or compromise payment should not be less than 40. So you can arrive at a final amount to be paid at around 60 or 50 or 70 or even 40, but not less than 40 because the minimum compromise rate would be 40%. 10% for financial incapacity makes sense because by its very nature, you don't have the capacity to pay. So you have to have at least 10% of the amount due. Compromise entered into between parties involved, particularly the BIR and the taxpayer, has the authority and effect of what you call res judicata, or it's as if it has been decided upon by courts. But this may be set aside by finding of mistake, fraud, violence, etc. Abatement you've already seen last time, but just to recap, abatement talks about the total cancellation of tax liability as opposed to your compromise, which only reduces the amount that you will pay. Again, the two bases of cancellation of tax liability is when the assessment is unjustly or excessively made, and number two, the costs involved do not justify the collection of the amount due. So for example, if the total amount of tax due is just 100, but the cost that the BIR will incur in order to recover that 100 would be 120, then it doesn't make sense. As mentioned before, authority of the CIR to abate or cancel liability, tax liability, is generally also applicable to surcharge and compromise penalties, but it may be extended to interest in meritorious cases. Now let's go to informant's reward. The tax law has a provision incentivizing provision of information crucial for the collection efforts of the BIR. So any person except BIR officers or public officials or even relatives within the 6th civil degree of consanguinity or relationship who voluntarily gives definite and sworn information not yet in the possession of the BIR, which leads to the discovery of frauds resulting in the recovery of revenue, surcharges, or fees, conviction, or imposition shall be given such reward. So what or how much is an informer's reward? It's 10% of the revenue, surcharges, or fees recovered, or fine or penalty imposed and collected, or 1 million pesos, whichever is lower. That's section 282A of the tax code. So if you have any information that will lead to the collection of taxes, then you might want to remember section 282. If you want to report someone or a company that's trying to evade taxes, then remember section 282. We've been talking about surcharges and interests a while earlier, but just to be certain, we can touch upon it as well. So let's talk about surcharges first. Now, surcharge is an additional amount imposed by law in case of delinquency. This is 50% for false or fraudulent tax returns, and 25% for late filing and late payment of tax. These surcharges are imposed regardless of the number of days delayed. So whether you only miss the deadline by 1 day or 1 year, that surcharge is fixed already. So if you owe the government 100 and you missed payment by 1 day, even if you paid the 100, you're liable automatically to a surcharge of 25%. You will be prima facie considered or preliminarily considered to have filed a false or fraudulent return if you have what you call, or you have committed what you call a substantial under-declaration of taxable sales, or substantial under-declaration or over-declaration rather of deductions or deductible expenses. Failure to report sales exceeding 30% or claim of deductions exceeding 30% of actual deductions shall also render the taxpayer liable for 50% surcharge. So if the BIR discovers that you over-declared your expenses or under-declared your taxable sales, which both operate to lower the tax, that net income, and effectively lower the tax due, that constitutes prima facie evidence of false and fraudulent return, then you will be imposed to 50%. You will be imposed with a 50% surcharge. On the other hand, when you have interests, a taxpayer is liable to pay interest at the rate of 12% per annum. Now, take note, upon effectivity of the Train Law, the interest rate has been moved from 20% to double the legal rate of interest. So currently, the legal interest rate is 6%, so double that is 12. So interest of 12% per annum from the date prescribed until the amount is fully paid. Under the law, imposition of surcharge and interest is mandatory in order to discourage delay and non-payment of tax due. Even good faith in failing to pay tax upon advice of counsel is not sufficient justification for seeking exemption from payment of surcharge. So as future business leaders, the most important thing that you can recall or take away perhaps from this lecture is that do not forget the deadlines for payment of your taxes. Otherwise, you will have to pay a hefty price, literally, because of the surcharges and interests. However, there's one exception. If the delay is based on a very difficult question of law, then that 25% surcharge can be dispensed with. There are instances when the BIR or the tax office actually waive the surcharge based on an interpretation on when the last day or the deadline will fall or when it will become due. But that was a few years ago. I don't think that's been an issue ever since. After the administrative remedies, you also have judicial remedies. So when is judicial action pursued? Actions for civil or criminal cases for collection of taxes may be pursued in the discretion of the tax authorities charged with the collection of such taxes with or without pursuit of distraint or levy. So they can skip the administrative remedies altogether and institute the corresponding action against an erring taxpayer. Your civil action refers to actions instituted by the government to collect internal revenue taxes at the regular courts, the MTCs or the RTCs, depending on the jurisdictional amounts involved. Or, in the alternative, a criminal action may be instituted by authorities for the collection of delinquent taxes. Case in point, tax evasion cases. Judgments arising from such cases impose not only penalty, criminal penalty, but also order the payment of the taxes involved. Let's say, for example, the government opts to lodge a criminal case against an erring taxpayer, and the taxpayer was proven to be not guilty. What happens to the tax liability? If a taxpayer is acquitted of such criminal case, such acquittal does not exonerate or exempt him from his civil liability to pay the tax due if there is a tax that should be paid. The obligation to pay taxes does not arise from a criminal act. In the case of Republic versus Patanao, if the acquittal is based on the fact that the failure to pay was due to a reasonable cause and not because of willful neglect, then They have to be viewed separately. What happens then if during the pendency of a criminal tax case like a tax evasion case, the taxpayer decides to pay the tax subject to that criminal case? Any subsequent satisfaction of the tax liability once that criminal case has been lodged, say for example for false or fraudulent filing of returns, it doesn't operate to extinguish the criminal liability. Remember, in the case of People versus Tierra, duty to pay taxes is independent of any attempt on the part of the taxpayer to evade the payment. So, in tax evasion cases, the criminal act is not really the failure to pay that of tax, but the intent and actual evasion of the tax, regardless of the amount involved. Thus, the satisfaction of civil liability is not one of the grounds for the extinction of a criminal action. Just one last concept for BUS Law 3, let's talk about rules on prescription. So what's prescription? In the legal sense, prescription is a mode of acquiring ownership or other real rights through the lapse of time in a manner and under conditions prescribed by law. Your prescriptive periods, on the other hand, refer to the respective periods of time within which various actions or proceedings in law must be brought. A law or provision in the law prescribing the period within which a party should enforce a right or resort to the courts for redress is what you call a statute of limitation. So prescriptive periods have been put in place by law, particularly by the tax code as well, in order to secure the taxpayer against prolonged and unreasonable investigation after the lapse of the period prescribed. Hence, once prescription has set in, the BIR can no longer run after the taxpayer for taxes allegedly unpaid or due. Fixing of periods are beneficial not only for the citizens but also for the government. The citizens are given a sense of security against unscrupulous tax agents, and the government will have officers obliged to act promptly. Without such legal protection, taxpayers would be open season to harassment by unscrupulous tax agents. When it comes to construction or interpretation, being a remedial measure, prescription is designed primarily to protect law-abiding taxpayers. Hence, it is liberally interpreted in favor. You've seen this earlier, but these are the prescriptive periods applicable to taxation. Generally, the period for assessment is within 3 years from the date the return was due or filed, whichever is later. But except in case of failure to file a required return, or a return filed is false or fraudulent, the prescriptive period is 10 years after the date of discovery of such omission, non-filing, falsity, or fraud. Generally, the discovery of falsity or fraud or the failure to file a tax return must have been made within the 3-year prescriptive period provided by law. However, because the ground or the basis for the assessment is the omission or the non-filing or falsity or fraudulence of the tax return concerned, the law expressly grants that the prescriptive period for assessment must be made 10 years from discovery of the BIR. This means that regardless of when that discovery is made, the 10 years will run from the point or time of such discovery. The example we made during the last lecture is that when the taxable year concerned is 2002 and the non-filing or the falsity in the tax return was discovered only in 2020, then you count the 10 years not from 2002 but from 2020, because it was only in 2020 that the non-filing or the falsity was discovered. Prescriptive rules when it comes to collection, not on assessment but on collection. When an assessment is made, the period for collection, either through levy, distraint, or court action, is within 5 years following the date of assessment. Once an assessment has become final, executory, and demandable, it doesn't automatically always happen that the taxpayer will pay, right? So the BIR will now have 5 years to run after that taxpayer to collect on the tax due. If the BIR does not make any collection efforts or fails to collect within that 5 years after the assessment is made, then prescription will also set in. If there's no assessment made and the return was filed, collection on the part of the BIR must be done within 3 years after the return was due or filed, whichever is later. periods may be extended subject to subsequent written agreements. And on that note, we finish our lecture on tax administration and procedure as well as BUS Law 3. So congratulations for finishing the course, and I wish you all the best in your future endeavors. Thank you.